Hello everyone and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today we're going to be going ahead and exploring how to pay off any loan with your credit card, with your line of credit, even if you have a checking account, a savings account. But we're going to show you the wisdom in using your line of credit instead of any other account. And we're going to show you on the board here. But before we do that, can I ask a favor? Like, share, and subscribe so that everyone around the world, we already got people in the Netherlands and other places, checking out the Velocity banking method and making sure they're using it to their advantage instead of the banks. Are you ready? Let's get into this. Now, this illustration may seem very familiar to you, but I want to introduce the wisdom in doing Velocity banking from your credit card, from your line of credit. Okay, so here we have on the line of credit side, we do have a balance of $12,000. We have a limit of $15,000, and we have the interest rate at 21%. And we have that minimum monthly payment set by the credit card company at $600 each month. Now you see to my left, your right, that on the income side, we're making $5,000 each month, which is the national average of the households in America. Now, we have the big bad wolf, right? Which is called the loan. It could be a personal loan, it could be an auto loan, it could be a home loan. It doesn't matter what the loan is. We want to make sure that not only are we paying this loan off as fast as possible, but at the same time, simultaneously, we are building credit, whether it's business credit, whether it's personal credit, that we are building our credit at the fastest possible rate as well, okay, simultaneously. Do you know how that's going to happen? It's going to happen through our credit cards or through our credit lines. Reason being is if we were to say, okay, we have a minimum monthly payment on our loan of, let's say, $200 each month. That loan is at, I believe, $5,000. You want to just put $10,000 instead, right? Name a number, right? $10,000 for easy math, okay? That's the loan. But it's $200 each month. Of course, we can segregate our income and make sure that that $200 is paid each month. And we can also continue to pay the $600 each month with our line of credit. Or we can do something different. And we can do this like this. Because at the same time that we are paying our loans and that we are paying our credit cards, we could actually, and get this now, we could actually be simultaneously paying this loan off as well as making sure the credit card bureaus are reporting our payments on the line of credit, but not only that, in the best way possible. Now, let me explain to you what I mean. You see, if I continue to pay from my income the $200 each month, and I continue to pay from my income the $600 each month, it's not going to be as effective or efficient as me doing this instead. Let's do this. Can I have you open your mind for just a little bit? Instead of segregating our income and heaping up tons of interest on our loan by just paying the minimum payment, we're heaping up tons of interest on our credit cards as well. Let's do this. Let's take the $5,000 and use our line of credit as our new checking account so that, and we haven't forgot about the loan, so that we can pay our line of credit and our loan in a more effective fashion. Because now the income is going inside, it's being transferred, but the bank will take it as a payment, right? it's being transferred to the line of credit. Our income is being transferred to the line of credit. And from the line of credit, we are paying our loan each month. Now, as this balance gets back to zero and you have the full 15, how fast do you think you can pay off this loan? Because remember, you're also going to be implementing the chunking method. How fast do you think? Now watch this. You're back at 15. Okay. You're already saying, you know what? I'm going to put a certain amount inside of my loan so that this $10,000 loan can actually be subtracted down substantially. Now, when you get back to 15,000, you know, you can, if you want to, take care of the whole loan. But if you want to build that credit, what you want to do is you don't want to throw all the interest away, right? You want to keep some of that interest. At the same time, simultaneously, you want to go ahead and give a little bit of the interest away because you need that reporting to the credit bureaus. Because as you're being reported as an amazing payer, because you're paying the balance, right, of that $10,000, you're going to be paying that off, okay? At the same time, you will be paying that minimum monthly payment. You will also, when this gets filled back up, you'll be chunking a certain amount to the principal. So let's say you've paid it off to $7,000, okay? You've paid it off to $7,000 because you wanted to chunk $3,000 at the loan, okay? You're still wanting to make that payment. You're still wanting to get it reported. And so now, once it's at the $7,000, that interest that is being charged on it, let's say it's at 5% interest, right? That interest that is being charged on that balance is getting less and less and less as you are utilizing the velocity banking method. Now notice, you haven't paid either one off immediately. You're paying a month at a time and strategically transferring from your income to your line of credit. Remember, the bank will call it a payment, but you know it as a transfer because you still got to pay your expenses and you still got to pay your debt payments. You're going to be paying that from your line of credit instead of your checking account. Now, for now, the income has to be direct deposited inside of your checking account. But the good news is you can transfer an amount from your checking account into your line of credit, and you can use the same amount from your line of credit to either chunk the principal and pay the $200 a month on that loan, the minimum monthly payment on that loan, or, and it's up to you, or you can pay it all off at the same time. Since you do have a credit limit of $15K, you can say, you know what, I'm done with the loan. I'd rather be charged simple interest instead of the scheduled interest. Instead, I think that'll be a better economically for me. Because remember, this 5% is different than this 21%. Oh, check out my other videos. Yeah, because amortized interest or complicated interest is worse than simple interest. Do the math. We do it plenty. We got over 600 videos letting you know that there is a calculation that's much different. And so that's why you want to implement the velocity banking method. And why? Why else? Why else? Well, because when you have a limited mindset, you're going to use credit to consume. But the unlimited mindset uses credit as a leverage. Now, if you're irresponsible, of course, go ahead and do like that one guy says, cut up your credit cards. But if you're responsible and you recognize that you can use these credit cards to leverage wealth, well, then you're on your way to an unlimited mindset. And so let's go ahead and just overview. Remember, you're going to Stop using the checking account as just a checking account. You're going to be transferring, right, the amount that you're getting paid inside of your line of credit. That's going to dramatically reduce your balance. Okay. Of course, we know you got expenses. Of course, we know you got debt payments. Pay them from your line of credit. And what that will do is it will dramatically reduce the interest that you owe, and it'll cancel it out, the interest that you owe on the line of credit. And before you know it, this amount will be filled, your credit limit will be filled back up, your balance will be zero, and this loan will be paid off before you know it. And the reason why you want to keep a loan, or the reason why you want to keep on paying from the line of credit, is because these accounts report to the credit bureaus. And what happens when the credit bureaus look at you and say, my goodness, this guy, this girl is paying thousands of dollars each month. They're on time with their payments. And you know what we're going to do? We're going to make this person a victim of a credit line increase. And that is why you use your line of credit. That is why you don't want to pay off immediately your loans. And that is why it's much better than a checking or savings account. Because at what time does the bank say, you know what, you've been a good steward of your wealth over here in your checking and savings account. Let's go ahead and give you a $10,000 raise. It will never happen, but it will on your line of credit. Folks, in a debt-based economy, you have to do debt-based genius thinking. Now, if we were in an asset-based economy, you would have to do asset-based genius thinking. We are in a debt-based economy. When you're in that economy, you use debt to get out of poverty. You use debt to get into wealth. And that's how it's done. God bless you, and we'll see you in the next video.